시시각각 요동치는 월스트리트. 하지만 이곳에서도 오랜 기간 동안 사람들의 존경을 받는 투자자는 있습니다. 워렌 버핏, 찰리 먼과 같은 전설적인 투자자들이 가장 신뢰하는 투자자로 이름이 높은 하워드 막스 오크트리 캐피털 회장이 그 주인공입니다. 하워드 막스가 월가의 오랜 신임을 받게 된 것은 그가 발간하는 투자 레터, 메모 덕분입니다. 이번에는 한경미디어그룹 독자들을 위해 한국어 버전의 메모를 독점 공개하기도 했는데요. 저희는 하워드 막스를 직접 만나 메모에 관한 이야기와 함께 미래를 보는 통찰을 직접 들어보기로 했습니다.
First of all, it's really thankful for this interview, and because of the time, and we have to move the first question. So we read the memo you published. Basically, I have to ask, what is the background of the huge theme of this memo and the title of the window of change for investors, please?
The memo does not have immediate implications for investors. I mean, there's nothing where you should read it and say, oh, then I have to do this. This was big ideas, not small ideas, big ideas. It strikes me that since we've all been locked up during the pandemic, the key thing is that every day is like the next. There's no variety. We don't travel, we don't go out, we don't have holidays, we don't have events. Every day is the same. And in the investment world, there has been relatively little change over the last year or year and a half. We have a very strong economy, incredibly strong markets, worry about inflation. Those things were true a year and a half ago, and they're true today. So these things, you know, if you said to me, okay, well, what's different? Nothing's different. All those three things are just going on. But there are some changes going on in the larger sense, and that's what I wrote about it. But they are not action items for investors. They don't have immediate action implications, but they are things that I think we should all think about.
Okay. As you said, it's not the immediate step,
Right.
But after this situations, I mean, the COVID and everything you indicated, and will you and Oaktree take some different, but more general investment approach amid the window of change?
We have our investment philosophy, and we have our process. And for the most part, we continue that. And that doesn't change from time to time. What changes is that sometimes we're more aggressive, and sometimes we're more defensive. And I think that rather than say buy, sell, in, out, I think the most important thing is today, are you more aggressive than usual or more defensive than usual? And my answer at the present time is neither. We're in a normal stance.
Normal stance.
Normal stance. Normal balance of aggressiveness and defensiveness. In March of 2020, when the disease struck, we turned very aggressive. And you know, we are very experienced and I think very skilled at becoming aggressive when everybody else gets panicked. And of course, if they panic and sell, and we are aggressive and buy, that's the best formula. And that was the case in March of 2020. And we bought aggressively. Then, however, the Fed and the US Treasury came out with a rescue program, and the panic went away. The urgency to sell on the part of investors evaporated. And there was no reason anymore to be aggressive. So we went back to our normal stance. We are certainly not, I mean, I think that the markets have come too far, have risen too far to be aggressive. But I also think that the worrisome conditions are not here to be highly defensive. So our behavior is, for us, normal.
All right, then let's focus on your memo. Let me quote you mentioned. The people in the 60s believed that investors embraces these companies with their revolutionary newness, but somehow assumed that a newer and better company would never come along to replace them if we put them on this asset market. I mean, nowadays, do you think we can accept something like crypto company or a cryptocurrency market as something new, not an illusion?
This is something that struck me. I hadn't thought of this before, but while I was writing the memo, it appeared to me that, you know, in this group of nifty 50 companies in the 60s, we had Xerox, IBM, Hewlett Packard, Texas Instruments. As I say, these were companies, they had the new thing. Growth investing was new. High technology was new. And everybody got excited about these new companies. They thought that their newness was a wonderful thing, but they thought that these companies could never be negatively affected. In other words, nobody said, well, if a new company can come into existence, what's to keep a newer company from coming into existence and knocking them off? Nobody ever thought about that. People thought that those companies were safe. And many of them got into trouble. Not just their stocks fell, their businesses became difficult for a variety of reasons. Mm-hmm. The new theme, and I wrote a memo back in January called Something of Value, talking about my experience being locked up during COVID with my son and his family who moved in with us. You know, nothing is forever.
Nothing's forever.
The world used to be a stable place. Nothing changed very much. Today, change happens all the time. And we're sure that 10 years from now, the world will be very different from what it is today, which means that an investor has to think about the future. In the unchanging world of 50 years ago, we thought that the world would stay the same. And the forces that were at work 50 years ago would remain the same. Now we know everything changes very rapidly. And so we can't have an approach to say this is a great company and this company and its industry will never experience change. We have to anticipate how the company will change, how it will be affected by competitors, maybe new competitors. Mm-hmm.
The Fed is expected to speed up tapering maybe today, or speed up interest rate hikes even. So will this serve as an opportunity for economic and market growth slow or even stop?
It's important to realize that things like bond buying are stimulative. They cause the economy to grow faster.
Right.
So the Fed has been buying roughly, I believe, 120 billion a month for a year or so. That's highly stimulative. Let's say they cut it in half. They buy 60 billion a month. That is still stimulative, just less so. Let's say they go to 15 billion a month. Still stimulative, but even less.
Right.
So my point is that reducing the bond buying, tapering, is still stimulative, just less so. It's not contractionary.
Right.
Now, psychology can decline
Right.
because the Fed is not stimulating.
But actually,
People can express disappointment because the Fed is not buying anymore.
much, yeah.
But the reduction of buying in itself is not contractionary. So they're still stimulating, but less so.
do you think the stock price of the company leading in the U.S. economy, like the Apple or another things, is currently at a reasonable level, or tendency to getting a reasonable level, or getting down or getting up?
I wrote a memo in July, you may have seen, thinking about macro. And what I said in there is I think today's stock prices, including the great companies like Apple and Amazon and so forth, they're high, but they're not irrationally high. Mm-hmm. There's a reason why they're high. The main reason is because interest rates are so low. And interest rates play a direct part on determining asset prices. Basically, the higher interest rates are, the higher the return most people demand. If they can get 3% on cash and 5% on treasuries, then in order to go into stocks or corporate bonds or real estate, they demand even more to compensate for the risk and any limitations on liquidity. So the higher interest rates are, the higher the demanded returns by investor, and the higher the demanded returns, the lower the asset price. Because if a given asset, you have an asset,
yeah,
you think it's going to return 6% a year. So it sells at a certain price. Then investors say, no, we want 9%. 6 is not enough. So the price has to go down so that the prospective return will be high enough to satisfy investors' demands. So interest rates up, prices down. Interest rates down, prices up. It's a direct effect, especially in the bond world. You know, you have, let's say there's a 6% bond. You buy it at 100 cents on the dollar, what we call par. You buy it at par, you think you're going to make 6% a year. And if they pay, if they don't default, you will make 6% a year on a 6% bond. But if interest rates in the world rise, and you say, oh, I need 9, then the price of the bond has to fall to a level from which the return to maturity is higher. So there's a direct impact. And today, we have the lowest interest rates in history. So it would be reasonable if we had the highest prices in history. And you know, I think that in the stock market, if you look at the S&P 500 index, or if you look at individual stocks, I think that for the most part, stock prices are reasonable, rational, means make sense, relative to interest rates. Now, interest rates are likely to change.
Yeah.
Yes, to
hike.
You're doing this with your pen. Interest rates are likely to go up. They're more likely to go up than down. Interest rates up, asset prices down. Yeah. So in direct answer to your question, I think the prices of these stocks may be reasonable. I'm not enough of an expert on technology to know. But the prices of these stocks may be reasonable for today's level of interest. But if interest rates go up, it's reasonable to expect these prices to decline. And most people believe that A, interest rates will go up, and B, they're more likely to go up than down. Mm-hmm. So if that's the case, then I think you have to have some concern about the level of the prices of all assets. But I think that the likely developments may be negative for asset prices, but I don't think a crash. Mm-hmm. I think a moderate decline.
All right, thank
and
you.
I think that the likely decline is so moderate that it's not worth getting out of the market to avoid it. That's the key. You know, the key question is, what should the investor do? And if you think there was a huge decline coming, you should reduce your holdings. But if the decline is likely to be moderate, and if you don't know when it's going to take place, mm-hmm. then you should stay in and not disrupt your investments and continue to participate in the long-term benefits of being an investor, and to accept that there may be a decline, but probably not too big and too imprecise as to the timing to be able to do anything about it.
So now let's talk about the China. Is your point of view to China is a little bit changed after the recent environment changing, like the real estate companies getting a little bit difficulties?
Difficulties of the real estate companies, I don't think they're not a surprise. China has grown for a long time based on the very strong availability of capital. And one way you can make an economy grow is you make capital loans available to people like real estate developers. They'll borrow the money, they'll build new apartments. That's good for economic growth. Only one problem: who's going to live in them? You know, so sometimes you get more real estate developed than you have a need for at that time. And this is the result of what we call easy money, of capital being very freely available. And this has been a worry. I mean, I've been going to China for 15 years, and this has, I would say, always been a worry, because a great deal of China's, you know, China has really been an economic miracle over the last 30 years. They've come from a poor agricultural society to an advanced urban society. And they did it. One of the ways they did it, maybe the single most important factor, was easy money, making capital readily available to people who wanted to create businesses, build buildings, etc. At some point in time, you have to make a change from easy money to having decisions take place based on their economic merit. And that's what's going on right now. And the residential real estate developers were offered too much money. They took it. They built buildings. Some of those buildings may be unneeded right now. And this is a transition that they have to go through, from easy money to normal economic decision making. But this is not a surprise.
So that means predictable.
It was predictable. I mean, you know, one thing I like to point out is that in our business, we sometimes know what's going to happen. We never know when. And people who think they know when things are going to happen are really deluding themselves. But this is not a surprise. It will be, you know, we have to see how the Chinese government deals with this.
Actually, that was the most interesting point in the memo, just for me. Yeah. It was about the generation inequality. As you pointed out, due to the nature of politics and the problem caused by generational inequality is expected to worsen in the future because nowadays politicians, they don't need to take charge of them. So what social phenomena can be exemplified? Why I ask this is Korea also has a negative factor, that the problem of intergenerational inequality,
Yes.
and it's so serious, and that makes Korea has the lowest fertility rate. So do you have some
Fertility.
Yeah, fertility rate. So do you have some opinion to this?
Well, I mean, look, demographics, which is what happens with people, population, is very influential on economies and growth. If two people, let's say every man and every woman in Korea gets married, and each family has 2 children, then eventually the parents will die, the children will go on, they'll get married, and they'll have 2 children per couple. And as long as each couple has 2 children, then the population replaces itself. China had the one-child rule in order to conserve resources, but it makes it hard to grow. If every 2 people only have 1 child, then over time, the population will shrink. And that's what we mean when we say low birth rate, low fertility. Fertility is a reference to how many children the average couple has. As I said in the memo, one of the ways to think about GDP is that GDP is the total output of the country. You can say that the output is the number of hours worked times the output per hour. It gives you total output. It's very simple math. If I say what are your wages, you say, well, I worked 40 hours last week and I made $10 an hour, so I made $400. That was your economic output or income last week. So if the number of hours worked declines because of low fertility or grows very slowly, then it's very hard for the economy to grow very fast. And any growth in the economy would have to come from increases in productivity. Now, productivity is rising. This brings us back to Cathie Wood and technology and automation. So technology has the potential to increase the output per hour. But if the number of hours worked is declining or growing only very slowly because of demographic trends, then those 2 things are doing battle. And maybe low demographic trends can be offset by high productivity growth. Maybe. And maybe your country and my country can continue to grow, or even, maybe even speed up. Who knows? But it's a difficult question. And this business of the intergenerational equity is very important. I think if I can summarize my message for your viewers, there are 2 important things. Number 1, if people are going to do their own investing, they should be humble. They should not overestimate what they know. They should not, they should not do daring things on a guess. They should accept that they don't know what the future holds and invest humbly. The other thing is, as I said before, you should invest and keep your investments running. Don't interfere by getting out of the market and in the market and out of it. Jump from 1 to 1 to 1 to 1. Stay in, let it progress. And if you invest, if Korea grows and companies grow and profits grow, then the investor is certain to succeed in the long run. We can't do anything about the short run because of all that we don't know, but we're certain in a growing economy and investing in growing companies, we're certain to succeed. And that's what people should keep their focus on.
Okay, thank you so much
My pleasure.
for today.
Good questions.
Oh.
Well, I always enjoy my work with your company, and I look forward to the next time.
Oh, thank you.